Hey guys, what's going on? It's Luke with the Common Investor here, bringing you another video. Today's video, I want to discuss the trading strategy known as dividend capture. It is a bit of a swing trading strategy. A brief kind of description of what dividend capture is you buy the stock that has a dividend before the day before the ex-dividend date, and then you sell it on the ex-dividend date, and you collect that dividend on the payment date. So I'm going to get into kind of how that whole process works and show you a couple examples of a dividend capture strategy. Still stay tuned. All right, so jumping right into the video here today, I'm going to be discussing the dividend capture swing trade. I have pulled up here the NASDAQ dividend calendar site. So it's a really great dividend calendar. You can kind of go in and any date that you want to look at, you can click on the date. So I have it set for Monday here. So these are all the stocks that are going to go ex-dividend on Monday. So kind of going through kind of what each of these titles and descriptors for a dividend mean. Starting with the ex-dividend date. So the ex-dividend date is the day in which you hold that stock. If you hold it on the ex-dividend date, then you will receive that dividend on the payment date. So you can't buy the stock on the ex-dividend date. You have to buy it before. You have to hold the stock at the start of the trading day on the ex-dividend date. So you can't actually, Monday comes around at 2 o'clock, you're like, oh, hey, this stock goes ex-dividend if I buy it today, and I'm going to get the dividend. You got to buy it the day before. So if you wanted any dividends from any of these stocks here, you'd have to buy the stock there on Friday and hold it to the start of trading here on Monday, which is tomorrow. So the next title descriptor we have here is record date. So record date, not as important. Essentially, it's for the company shareholders that have the stock before this date are gonna get the dividend, and then that's how they make the ex-dividend date. So usually it's the day before for the ex-dividend date, and the record date's the day after. So not as important as the ex-dividend date. For any dividend capture or any dividend payments you're looking for, ex-dividend date is going to be your most important. Next up, we have the announcement date. So this is when the company announced when they're going to go ex-dividend and what that dividend is going to pay. So usually that's about a month in advance. Then the last one is the payment date. So this is where you're actually going to receive payment for your dividend. So in this example here, ASTE goes ex-dividend here on Monday, 3/11, and you're not going to get the 11 cents until 3/29. So depending on what company you're investing in, the payment date can be a little, a couple weeks after the actual ex-dividend date. So I want to kind of show you a couple of examples. It's dividend capture. It sounds easy in theory, however, it is a little bit more complicated than that. I'll get into why here in a second. So if we go previous here, we go to March 8th, which was Friday. So that was the last trading day that we had. If we scroll down, let's find a stock that we wanna look into. So, all right, so FedEx. So FedEx went ex-dividend there on Friday, 3/8, pay a dividend of 65 cents, and the payment date's 4/1. So if you wanted to invest in do a dividend capture for FedEx, for example, you'd have to have FedEx have bought that on the 7th, so Thursday the 7th, and then held it for the trading day of the 8th, Friday the 8th. And then usually what you do is sell that stock. So if we look at FedEx here on Robinhood, pull up the weekly chart. As you can see, Robinhood breaks down each trading day, so you can kind of see it highlighted. So here's going to be your Friday trading day, and here's Thursday. And as you can see, the day before, if you'd have to buy the stock here. If you bought it right before trading ended, so that's at 3:50 p.m. Thursday, March 7th, then you'd have to sell it the next day. However, usually when a stock goes ex-dividend, the stock price drops. So as you can see, at 3:50 p.m. Thursday, March 7th, FedEx was trading at 172.87, and then started trading on that Friday. Um, it drops to $168.83. So obviously, if you bought at 172 and sold at 168, you're not making a profit because the dividend's only 65 cents. So that's one of the tough parts about doing a dividend capture swing trade, is that you got to make sure that you're not selling at an actual loss. You basically, your break even point is going to be 65 cents, for FedEx example, below the actual price that you bought it, for you to even turn a profit. So as you can see, it may have worked if you held to about 10:40 a.m. at 172.61, and if you bought it at 172.68, obviously you're only losing 7 cents, but you're making a 65-cent dividend. So this would work as a dividend capture. However, it is very risky because the stock might not pop up like that. As you can see after that point, I believe a lot of people that were probably doing this strategy, took their profits right there, and as you can see, trended down. If we look at another example, we look at Cedar Fair. So fun. Ticker symbol FUN. Let's pull that up. So they, just like FedEx, they went ex-dividend Friday. So you'd have to buy that stock on the Thursday. And as you can see, here's their Friday day trading, and here's Thursday. So Thursday, usually the day before, kind of trending up. So if you bought at 52.60, drops 52.60 was the last 52.50 was the last trading price essentially at the close of trading on Thursday for Cedar Fair, and then the start of trading drops down to 51.71. Now that's not as big of a drop as FedEx, and if we look here, Cedar Fair actually pays a really nice high dividend of 92.5 cents. They're a nice high dividend payer. So obviously from 52.50 to 51.71. If we do the math on that, 52.50 to 51.71, we're losing 79 cents. So actually, the dividend's higher than that. So if you sold right at the start of trading, you'd actually turn a profit. And as you can see, it jumped up real quick there at 7.40 and then tanked down to 51.27. However, during the course of trading, it went all the way up to 52.75. So you could have even had a successful swing trade for capital appreciation and getting that X dividend. So there are cases where it can work, and in the couple of examples that I showed you there. However, it doesn't always work like that, and it is sometimes really risky to do the dividend capture. And then just so you know, once you do get that dividend, you obviously have to pay taxes at the end of the year there, and that's kind of how the dividend capture strategy works there. And I'm going to really leave it at that. That's kind of the basics of what the dividend capture swing trade is. So if you guys like the video, feel free to like, comment, and subscribe. Let me know in the comment section below. Have you done a dividend capture swing trade ever? Do you plan on doing it? And if you haven't already, obviously hit the subscribe button, and let me know what you guys want to see next. And I'll see you in the next video. Thanks, guys.